Hello and welcome to NDTV Profit. The currency market has been abuzz with the RBI circular, or rather reinstated circular on the exchange-traded currency derivatives regulations. There is a panic situation at trading desk of several brokerages who are scrambling to wind up their positions in the rupee futures market. We have Mr. Abhilash Koikkara, Head of Forex and Commodities at Nuvama Group with us to discuss what this circular actually means and why is it causing this chaos. Welcome, Abhilash. My first question to you is what, according to you, is the rationale behind this RBI circular? And anyone who's transacting in the currency futures market has to have an underlying unhedged forex exposure, which is what the RBI states. But why is it causing this panic? Because to my mind, I think that is what the RBI had always said.
Yeah, so thanks, Mimansa, for having me. So let me just put things into context. So RBI had come up with a circular in 2015, 2018, right, that exposures up till $100 million US can be kind of traded on the exchange for hedging, right, without giving any underlying, right. So the person who wants to actually trade on the exchange does not necessarily have to give any underlying or a contracted exposure. Beyond 100 million, we are supposed to provide an exposure, right. Now what has changed is that in January, there is a circular which has been come from RBI, which has clearly stated that even if you are trading within the 100 million limit, there has to be an existence of a contracted exposure. So even a quantity of $1,000 or $2,000, if someone is trading on the exchange, the existence of that underlying contract has to be there. When I mean an underlying contract, basically it is that if you are an importer or an exporter, you should have an invoice or a bill of lading or a contract which is basically saying that you have a particular amount of exposure in foreign market currencies. Only with the existence of that is what you can trade on the exchange, not without that. So basically for people who are trading without any underlying exposure, this has kind of meant that they will not be able to trade post 5th of April 2024.
Okay, so the underlying exposure that a client has and their trading positions, they have to be equivalent. Is it?
Correct. So basically what it says is that in case the client is taking a position of say $10 million for the June maturity, he should have at least $10 million of exposure, and the maturity of his actual invoice has to be beyond June. So it cannot be an exposure which is for May and he has taken a position for June. The exposure can be June or beyond, but he has to have that amount cannot be more than his contracted exposure, and the duration cannot be higher than the duration of his contracted exposure. So the actual invoice has to be, or the contract with the client has with the party, has to be within the contours of the contract which is actually hedging.
Okay, okay. So this circular that came on January 5th, it is exactly the same as what has been already mentioned by the RBI. So nothing really has changed on the regulation front. It's just that now clients will have to give a proof or an evidence of their underlying exposure equivalent to their positions in the market, right?
Yeah, so earlier the thing was that there was not a requirement of an existence of exposure till $100 million because neither exchanges nor brokers were asking for it. But now the new regulation being circular being very clear that there has to be an existence of an exposures. Now exchanges as well as brokers would be asking for some undertaking and the underlying exposure for any person or a company to trade on the exchanges on the currencies which are denominated by INR, which is typically today is USD INR, GBP INR, Euro INR and JPY INR. So all these currencies, if someone has to trade, they have to kind of give an undertaking as well as the contracted exposure basis which they are taking that position on the exchange, which was not the case which was followed before the circular came into existence.
Okay, okay. So Abhilash, if you could explain it for the viewer that in the futures market, who are the participants and
Sure.
what percentage of participants and what percentage of speculators and arbitrageurs are in the market, and how is it going to impact the...
Sure. So if I look at data which we have been studying, roughly around, if I'm not wrong, around 5 to 6% of the market volume is from corporates, right? These are proper hedgers, right, who have underlying import-export exposures. Around 7% to 8% is FPIs, right, who are on institutions and FPI who are hedging their kind of exposures. And rest of is a mix of arbitrageurs, it is a mix of speculators, and it's a mix of prop desk. So if I had to put a number, around 85% of the volume are not volume for hedging purpose. right? And as per the RBI circular, which is kind of clearly saying that they want to ensure that exchange traded currency derivatives are used only for hedging purpose. and it was brought in with that intention of that SMEs and MSMEs could hedge on the exchange. But if I look at the current scenario, after almost 15 years now, since the contract has been launched, around 85% of the volume is non-FPI and non-hedging volume, and it is majorly driven by arbitrageurs, prop traders, and speculators in the market.
Okay. Okay. So does that mean that this entire 85% of turnover that was coming from speculators and arbitrageurs is going to go away, and then the currency derivatives market is going to go for a toss? Or what is the outlook on the market in general?
Yeah, so for a natural hedger, actually nothing changes, right? Because earlier he used to, so basically you need to understand, even if someone is doing some forwards through banks, they have to give an underlying, right? The same way, if an importer and exporter wants to hedge on the exchange, they can give an undertaking as well as an underlying, and they can hedge on the exchange. The difficult part which market is trying to gauge, and that is where the entire panic is about, is that if 85% of the market is not allowed to trade, because these were basically, as I said, prop traders, arbitrageurs, and speculators, we did not have actual underlying to kind of trade on the exchange, then even if someone wants to naturally hedge their exposure on the exchange, they will not find any counterparty, or that kind of liquidity will not be there to kind of encourage the SMEs and MSMEs to come on the exchange. So the purpose that it should be only for natural hedgers, for them nothing changes from a circular perspective for hedging, apart from the fact that we'll have to see how much liquidity is left in the system once this 85% after 5th April, once this 85% of market participants are out of the market because they cannot provide underlying as of now.
Okay. Okay. Because you mentioned liquidity, and a lot of it has been coming through speculators, and they're the market makers in the derivatives market. So do you think, and in the past we have seen that traders have taken the arbitrage opportunity between the NDF market, which is the offshore market, and futures market. So do you think this lack of liquidity, as it fizzles out, it's going to create more arbitrage opportunity? Can that continue?
Sure. So in terms of market mispricing, obviously this step might lead to some mispricing in the market because of lack of liquidity. And actually we have been seeing that in the last couple of days, where if you look at few option prices, those prices have got inflated as we are speaking today, right? Because the entire market has become one-sided, because they have to exit the positions by 4th. But whether it will be a long-term phenomena, it is difficult to say, because even for arbitrageurs, one basic requirement is liquidity, right? So if they are doing an onshore-offshore, typically people who have access to offshore would be large arbitrageurs, right? So if they are doing an offshore-onshore transaction, if there is lack of liquidity on the exchange, then that might deter them from kind of exploring those arbitrage opportunity. So I find this mispricings will prevail for some time, till the time the entire positions get scored off, because market is one-sided now, which is kind of visible as we speak. But I don't see any persistent arbitrage opportunity to be lying there where people will exploit it because of the liquidity constraint which will come in the exchange market post the circular comes into effect on 5th of April.
Okay. Okay. Which is exactly what RBI wants, in a way, that they don't want any speculative trades happening in the currency market. That
looks to be clearly the intent of the RBI. As I said, for a normal hedger, the intent of RBI as per circular is that currency derivatives should be used for hedging purpose for SMEs, MSMEs, and corporates. The only challenge, as I kind of earlier alluded to, is that any market, the volume is basically made by speculators, market makers, and arbitrageurs. So even if a hedger wants to kind of hedge today, the volume might be a stumbling block for the person to hedge on the exchange, even after having a contracted exposure. So which is basically the worry of the market. The liquidity of the market, which has been built over the last 15 years, it can kind of completely dry up. And people who have genuine exposures on their book, they might not be able to find counterparty liquidity on the market.
But they could go through forwards market as well, right?
Yeah, so they have the option of forwards with the bank, which they always had. The intent of enabling exchange was basically that on the forward side, the transparency and the pricing is dependent with a bank dealing desk. It's an OTC market, where on exchange it is very, very visible. You can kind of log on to your app and see what is the dollar-rupee rate today, right? What is the futures price? So ease of execution in terms of ease of entry and exit, ease of regulation. So all those things were kind of pushing the smaller corporates as well as the larger corporates to kind of increase their hedging on the exchange. But forward was an opportunity, or was an option which was always there in the market. So the idea was not to replace forward. The idea was to give a more accessible instrument for SMEs and MSMEs. That was, I think, the intent of RBI when we introduced currency futures. And now they are also re-emphasizing the same. Like if you look at the circular, it's okay, it's open for risk management and hedging. Yeah. But the worry again is the liquidity part, because any market requires all kind of market participant to generate the liquidity in the market. And if you have only one kind of participant, it can kind of be a little bit of struggle to find counterparty to kind of execute your trade.
Okay. But to your mind, do you think that this liquidity can be replaced by in any other way, or how can this be a problem that can be solved in a, say, medium term, because now the liquidity is going to come down?
Short term, definitely it is going to have an impact. Anywhere between 75 to 80% drop we can see, and we have actually seen drop in volume. Like we are around 25-30% down day on day from 2nd of April in terms of volume. In the long term, obviously, if more and more corporates get encouraged, right, to hedge on the exchange, more liquidity can come in. But again, I don't see it coming in the short term because now with anyone wants to execute trade, they have an option with the bank. So it has to be really liquid on the exchange for people to kind of take that effort to kind of hedge on the exchange. So more and more corporates getting involved by being comfortable sharing the underlying can be a trigger to kind of drive the volume. Otherwise, I think in the short term, medium term, looks difficult for us to get back to the volumes where the market were trading.
Okay, fair enough. In the last 2-3 months, there was a lot of exotic options trade that was happening in the market, and that was because of the RBI's consistent intervention in the market and keeping the rupee as stable as it was. Do you think that is also one of the reasons why RBI may have felt the need to reinstate the circular?
Yeah, so basically rupee was kept in a very tight range, right? So it has been in a very tight range. So there was a lot of option writing, right, in terms of, especially in options, right, in terms of positioning. And this could, and obviously because, as you know, currency is highly levered, right? So as of now, the margin requirement on currency is only 2.5%. So you get 33 times the leverage. So there have been instances where clients' positions have been there on options, and I'll not call it exotic structures, but structures on the options, right, which are similar to, say, what people do on equity FNO, right? So structures like that. So that had definitely increased. There is no doubt about that. And probably one of the intent of RBI would be kind of to take out that speculative options trading on the market, which a lot of retail participants also have got involved in. So that could have been one of the intent, but that will definitely again dry up the liquidity, because if they are out of the market, I think very few participants are there in the market. So this might be one of the reasons, apart from the fact that they only want it for natural hedgers and it should only be used as a derivative tool to hedge your exposures and not to trade. And obviously trading volume, as I said, is around 85% of the exchange volume today. So that might definitely be one of the reasons why RBI could have come up with the step that we require a contracted exposure.
Okay. Why I'm asking this is because in the last week's trade, when the rupee had gone to 83.70 in the offshore market, I think some barrier options were written off, and people were writing barrier options, and those stop losses were triggered and stuff like that.
So basically, those kind of exotic options like barrier options and all are only available at bank. So exchange maybe only have simple options, right, which is plain vanilla call and put, and you can make multiple structures out of it. But the knock-in, knockouts and barrier options are something which is happening on the bank side. So those kind of exotic options were not happening on the exchange. But yeah, people without underlying were definitely taking benefit of options trading on the exchange, because the margin requirement is less. And probably one of the intent, as I said, of the RBI would to kind of take away that speculative volume from the exchange.
Simple options they were doing.
Yeah, they were simple options. There are on the exchange there are no knock-in, knockouts, barrier options. So exotic options are not there. Only simple call and put options are traded, basis which you can make different strategies like you do in equity FNO, or commodity FNO, and you can trade strategies through that. But the exotic options is now never accessible through exchange.
Okay, got it. How relevant, this is the last question for our chat, how relevant do you think futures market is going to be after this circular, after April 5th? Because a lot of brokerages that we spoke to are expecting some clarification coming in from the regulators and some leeway coming in from the regulators. What is the future going to be for the currency futures market?
So as I said, we're definitely going to see a drop in volume. From an operational perspective, it is very similar to what the corporates were doing currently, apart from just giving an undertaking or underlying which they actually had. But from an execution point of view, it's going to be a challenge, and that is why I think most of the brokers are kind of waiting for some clarification. Can there be a reduction in the limit, or can RBI come up with more clarification which can encourage some kind of volume on the exchange? So that is what the brokers are waiting for. But as of now, there is no clarification from RBI. Even from exchanges, we have got clear mandate that you have to adhere to RBI circular. So in the short term, for definitely, we see the futures market getting dried up. And most of the clients going back to forward markets to kind of hedge their exposures, unless there is some clarification or some, if I could say, they use the word relief in terms of exchange volume which can come up. So definitely looks like a dip in the volume for futures market in the next quarter.
Right, right. So definitely compliance is something that is on everybody's mind, and brokerages are actually scrambling to do that so that they do not attract any sort of issues from the regulator side.
Correct.
All right, all right. Thank you so much, sir. This was Mr. Abhilash Koikkara, Head of Forex and Commodities at Nuvama Group, in conversation with NDTV Profit.